Gary Dugan's with us in the studio, Chief Investment Officer, Emirates NBD. Morning, Gary.
Good morning.
You're very excited about a G20 meeting coming up soon. Normally these things, they come and they go and not much happens. You think this one could be a biggie. You think this one could go down in history, Gary. Tell us why.
It's a hope, but we've got to live on hopes at the moment with the markets as they are. I think, given the reaction of markets, particularly overnight, a pretty violent down leg again in all risk assets, you've got to hope the policymakers deliver. And they have an opportunity towards the end of February that there is this G20 meeting of finance ministers and central bankers in Shanghai. And if you think back through your economic history, you hear things like Louvre Accord, Paris Accord, the Bretton Woods changes in 1944. The world really feels at the moment it needs something of that scale.
So maybe the world needs something of that scale, but what makes you think we might get there? I mean, if you look back at Bretton Woods and these agreements, they were forged in the wake of cataclysmic world events, not a little recession, World War II. We're not at that stage, are we, Gary?
I hope not, but it really feels after 7 or 8 years of policymakers having tried different attempts to get the global economy going, that over the most recent weeks and months we've just seen again another trail of pretty awful news out of the economy saying it's just going nowhere. And I think as we go through the balance this year, there's a fear that we may start to see a rise in unemployment again. And these are things that are going to shock policymakers into doing something. Maybe February's too early, but there is an opportunity at that meeting, crucially in China, for there to be some wave of new economic thought.
So what could they do? I mean, if you're talking of a Bretton Woods style meeting, this is fundamentally changing the architecture of the global economy and gold standards, and then leaving the gold standard. What would be the equivalent policy move of either introducing a gold standard or removing one? What would be the equivalent today?
Yeah, that's a tough one. I think on monetary policy, we're kind of toying, in a sense, with negative interest rates. No one knows whether they're going to work. Secondly, we're kind of getting to the point where no one believes in any currency. I mean, the dollar's been going up because it looks like the best thing out there, only because everything looks so bad. And that's why we believe that people will revert to gold in the near term. We're trying to convince our investors to put maybe up to 10% of their portfolio there. But the one thing that we do need to see, I think, is another wave of significant increase in government spending. And they can get out of jail a little bit on this one by not, in a sense, debt will go up. But if it goes up for a good reason through infrastructure spending, then I think it could be accepted by the markets.
We didn't have these problems, Gary, when we traded with sheepskins and shiny beads. Let's go back to those days. Japan said last week that they wouldn't go back to negative interest rates, but they have. Do you think we're likely to see carry trades as we saw 8, 9, 10 years ago when cheap Japanese money flooded out to other higher interest rate environments such as Iceland, which was largely, of course, the trigger for the Icelandic crisis when the money was withdrawn? Are there enough higher interest rate environments around to attract carry trades today?
I don't think so, and I think part of the problem is they've already attracted a lot of capital. They've built up a lot of indebtedness, and people just see them as too risky. And also, those yields are flattened so considerably. You don't pick up 10 percentage points of return anymore. You're picking up 1 or 2 or 3. So I don't think you get paid well enough for some of the risks that you'll be taking.
You've got me looking back into my economic history now, Gary, so thanks for that. I'm looking at the Plaza Accord, 1985. 5, was it finance ministers or central bankers? There's a wonderful black and white picture, and you've got Gerhard Stoltenberg of West Germany, as it was back then in 1985, Pierre Bérégovoy of France, and representing the United States, Malcolm, James Baker III, who we were talking about.
It's his son, I think, that came here.
That came here with the law firm. Yeah. Nigel Lawson of Britain and Nobuyuki Takeshita of Japan. So back in 1985, if you needed to kickstart the global economy, those are the 5 people you needed. Those are the 5 economies you needed. America, Japan, and then France, Germany, and Britain. Who would we need in the room this time if they go back to the Plaza Hotel in New York City, or whichever hotel they're in Shanghai later on this month?
Yeah, put simply, it's the host, China. We see China, along with the oil price, along with maybe 1 or 2 other factors, as the key issues that we're really facing today. China growth rate has fallen a long way. We don't know where it's going to bottom out, and we need China to be fully engaged in the global economy in a stable way. Talk of devaluation is just not helpful at the moment. So I think there's if they could do it at that meeting, is provide some stability of where is the policy making going to move us in the future. How long do the policymakers think we're going to be in this real rut, and what they're going to do to really bring us out of there and give us 5 years of good news?
Well, that sort of links to the next question I've got for you. Emirates NBD, until recently, has been standing by its prediction of 4 interest rate rises this year, but market conditions have changed. Are you standing by the prediction of 4 interest rate rises in the US this year, despite what's happened so far in the last month or so?
That still remains the forecast. I mean, I think the Fed still hopes that they can increase interest rates by 4 times this year, and I think that they hope that that growth will coming through. Clearly, the markets, with the data we've seen in recent weeks, are betting massively against that kind of call, but that remains the hope.
So, in terms of investors, people listening to this, what do we do with our money at the moment? Do we hide it under the mattress, or is there a more sophisticated strategy?
There's places you can make money. The 10-year bond and most of the bond curve in the United States at the moment has made money for investors since the beginning of the year. So we're advising our clients, yes, have a good measure of cash, maybe as 20% of a portfolio, have a significant exposure to very safe bonds, which typically, again, is US dollar debt from the US government, and then a good measure of gold. There are certain funds out there that are focused on absolute return, and again, typically they've offered positive returns for the beginning of the year, but it is a very defensive strategy, and for most people they would say that's just hiding the money under the mattress.
20 seconds, gold, where is it at the end of this year?
I think we could be up to 1,300, so it gives you a good 15 to 20% upside from current levels. I do think that people will revert to gold as just a safe currency to put money in, and I think as we see central banks maybe change their policy, that could reinforce the positive story for gold.
PJ writes, and he likes what you say, Gary. At last, someone else who advocates a major step change in global economic management. Gary Dougan, Chief Investment Officer, Emirates NBD, thanks for your time.
Thank you.